Hi everyone, hope all is well. Welcome back to our second part of Strategic Capital Stack, Equity versus Venture Debt. We've compared the basics of equity and venture debt. Now let's get concrete with real scenarios, because frameworks only matter if you can map them onto your actual situation. Scenario A, the early stage deep tech or AI startup. Pre-revenue, high technology risk, genuinely unpredictable timelines. My recommendation here is 100% equity, no debate. Mandatory debt repayments would force this kind of company towards short-term cash generation instead of the long-term technological moat it's actually trying to build. This is exactly the climate tech example I mentioned earlier. That founder needed specialized patient venture capital, full stop. Scenario B, the B2B e-commerce or direct-to-consumer brand with established unit economics. Here I recommend heavy reliance on debt. If every dollar of marketing spend reliably returns $3 in lifetime value, or your inventory converts to cash within 60 days, then debt aligns your cost of capital with your actual cash conversion cycle. Why would you give up quality equity to fund something as predictable and formulaic as proven inventory turns or proven paid acquisition? Using debt here preserves your equity for the moments that actually need it. A major expansion, an acquisition opportunity, entering a new geography. I've worked directly with founders in both of these exact situations. And what always strikes me is how differently they need to think about capital. The deep tech founder needed a patient partner who'd sit with them through failed experiments. The D2C founder needed a lender who'd get out of their way and let them scale a formula that was already working. Same goal, very different tools. Strategic choice may often depends on your next major milestone. Scenario C is one of my favorites because it's the clearest illustration of why venture debt exists at all. The SaaS company nearing a valuation milestone. Picture this. You're at 8 million in ARR with 12 months of runway left, but you know your Series B round really needs 10 million in ARR to price well. $3 million in venture debt buys you roughly 6 extra months to cross that threshold organically. If your next round then prices at roughly double the multiple because you hit that ARR bar, you've just saved yourself millions of dollars in dilution for the cost of some interest and a small warrant. This is the debt bridge strategy, and it's incredibly powerful when timed correctly. Scenario D, the highly capitalized later stage company. Right after you close a large equity round, lenders are offering their best possible terms because your balance sheet just got a lot stronger. My recommendation here is debt as insurance. You take the facility. You don't necessarily draw it down immediately. It just sits there as an unused credit line, a war chest for a downturn, or a sudden acquisition opportunity without touching a frozen equity market when you might need capital fastest. I actually helped structure something very close to scenario C. For a SaaS founder, they were about 4 months and roughly $1.5 million in ARR away from a Series B threshold their lead investor had all but promised at a much better multiple. We used a modest debt bridge instead of accepting a rushed, underpriced round. They hit the number and the eventual Series B priced meaningfully higher. That's the entire thesis of venture debt in one story. To double your price, later stage firms use debt as insurance, a war chest for downturns. This next one is genuinely my favorite slide in the whole deck because for sophisticated founders, it's rarely an either/or decision. It's a blend. Let's say your company needs $10 million to reach profitability. Option 1. Raise the full 10 million as equity at a 40 million pre-money valuation, so 50 million post-money. Your dilution on this round is a clean 20%. Option 2. The hybrid. Raise 8 million in equity at that same 40 million pre-money, so 48 million post-money, plus 2 million in venture debt. Your total dilution, including a small warrant, comes out to roughly 16.7%. That difference, 20% versus 16.7%, is just over 3 percentage points. On the chart, that might look like a small gap, but run that percent against a $1 billion exit, and founders just saved themselves $30 million in ownership value for the cost of a modest interest payment and a tiny warrant. This is why I tell almost every founder I advise to at least model the hybrid option before deciding. You don't have to choose 100% of one thing. The best run companies I've worked with treat their capital stack the way a good CFO treats a balance sheet. Deliberately blended, not accidentally assembled. The math here isn't complicated, but almost nobody does it before a raise. Take 5 minutes, model both scenarios for your own numbers, and bring that model into your next board conversation. It changes the entire negotiation.